welcome to Estate Planning, Introduction to Trusts. In our previous session, Estate Planning the Basics, mention was made about the use of trusts in estate planning. In today's session, I'll focus more on exactly what a trust is and its place in an estate plan. So what exactly is a trust? A trust is an agreement between two parties for the benefit of third parties. Assets are essentially placed under the control of trustees to be administered for the beneficiaries. Let's look at the types of trusts. There are mainly three types of trust, being an ownership trust, a bewind trust, and a curatorship trust. An ownership trust is the most commonly used type of trust out of these three types of trusts. Trust can mainly be formed in one of two ways, being during your lifetime, which is known as a living or an inter vivos trust, or after your death by way of a testamentary or a mortis causa trust. Let's look at some of the differences between a testamentary and an inter vivos trust. Firstly, an inter vivos trust will be formed during your lifetime in terms of a trust deed or an agreement, and because it's formed by way of an agreement, it's very flexible with regards to amendment. And fourthly, an inter vivos trust can be capitalized during your lifetime. With regards to a testamentary trust, it will be set up after your death by your executor, and it will be set up in terms of your will. Because of the fact that it's set up in terms of your will, it's not as flexible when it comes to amendments. Furthermore, the testamentary trust will only be capitalized after your death. Let's look at the capitalization of trusts. Firstly, inter vivos trust. Inter vivos trust can be capitalized by way of a donation from the founder to the trust. Because the donation is a gratuitous disposal of property, there will be a donation tax liability. Secondly, the inter vivos trust can be capitalized by transferring assets in the name of the founder to the trust. In this case, the assets are not transferred by way of a donation, but by way of a loan account or of a loan between the founder and the trust. In this case, there will be capital gains tax on capital assets, and there will be transfer duty on in the case of immovable property transferred to the trust. A third way of capitalizing an inter vivos trust is when assets are bought in the name of the trust, and then it's financed by way of a loan between the founder and the trust. In this instance, there will be no donations tax, capital gains tax, or transfer duty. Let's just look at the loan account, because the loan account will be an asset in the name of the founder. The most commonly used way for minimizing the loan account is for the founder to annually donate 100,000 Rand back to the trust. The reason for using the 100,000 is that it is an annual rebate for donations tax purposes. If the founder was married, him and his wife can combined, they can donate 200,000 Rand to the trust. So when should you make use of the trust? Let's look at an inter vivos trust. You can make use of an inter vivos trust if you need asset protection from creditors, for estate begging purposes. You have a large estate which will attract estate liabilities on your death. You would like your family to be unaffected by your death. You would like your assets to be administered for public benefit. You would make use of a testamentary trust, on the other hand, if you have minor children or family members that are not able to manage their own affairs. And in this instance, the trustees will benefit or will administer assets for and on behalf of these trustees. And you can also make use of a testamentary trust if you'd like your assets to be administered for public benefit. Let's look at some of the factors to consider when setting up a trust. It's important that a trust should always fit into your estate plan and should not be seen in isolation. It should fit into your will and to other structures that you already have. A trust should not primarily used for mitigating taxes, as tax legislation might change, and then you have no other use for your trust. The founder should divest himself of control over the assets. This is just to ensure that the trust is not seen as your alter ego, because if it's seen as an alter ego, the trust assets will ultimately be seen as your own, and there's no purpose in using a trust structure. Trustees can only administer the trust assets in terms of the trust deed or the will. There are annual expenses to keep the trust compliant. and a corporate trustee will ensure that the trust is properly administered and will not be attacked by third parties. This is then the end of estate planning introduction to trusts. Just a reminder that this video is only for information and educational purposes and should not be seen as advice. This video was brought to you by KP Fiduciary.